Hey traders, this is Josh at Option Sizzle doing a wrap up for Monday, January 25th. I'm going to talk about Apple, and this is a trade that I talked about in our elite chat room. I walked traders through it, explained to them exactly what I was seeing in the option market, also on the chart as well, which set up for a trade. Looks like it's going to do pretty well for us tomorrow and possibly going into the next few days. What I was seeing in the option market at the time was I saw a trade by the same trader. They went into the 200 put side and they sold the puts. They traded below bid, and at the same time they went for the 210 call, which was on the ask. At the time of that trade, prices were trading higher, which would indicate that a trade usually would go on the if they did it at the same time, prices are moving higher, the trade would go on the bid on the put side, and then on the call side, it would go on the offer, which looked like that was the case. Also, implied volatility had traded was lower on both of the trades, indicating that it possibly could have been sold, and that's the theory that I went with, that it was actually sold. I was seeing some other spread trades, the 220 calls being hit on the bid as well, and some other activity that kind of leaned me towards that. Taking a look at the options here, we could tell going into earnings between the skew of implied volatility that they're pricing in a little bit over a 10% move. So they're pricing in a $20 movement in prices. You can see here in after hours we're up about $5, but for that trader that did the 210 strangle, if that was the case, if they sold it, they made a pretty good. They're going to make a pretty good reward tomorrow, because that implied volatility for tomorrow is going to get crushed, and it's going to stay in these levels between the 200 and 210. Right now it's trading 205, so it's going to work pretty much perfectly. Let's take a look at the chart here. This is the chart that I posted for our members. I also posted on Twitter. You can see here we have a high here at 215, which we have a double top, somewhat forming here. And we also take a look at the bottom end of here. We have some support at 185, and we are currently trading, I would say, a little bit in the middle of that. So when I took a view of this, we can move 20 points below or 20 points higher. If we get into the 20-point lower section, this 185, this 180 area is going to be a good support level. We could see here back on the chart, this level right here, we're going to have a decent area potentially to be somewhat of a buyer step in for possibly for the short term or maybe the long term on a pullback. Or if we get a break higher, automatically this 215 is going to be resistance. But pricing in a $20 move, we're going to see a move up to if prices closed at the time at 202, at the 202-ish range. Yep, so about 202. So we're going to have to see a $22 move. I mean, that 10%. That's a very aggressive move. The trade puts up and puts us right in the middle of a range, which sets us up for a trade by selling the iron condor. Since we're right in the middle of here, we could sell the call spread and sell the put spread, and that's what an iron condor is. You're selling the put spread and you're selling the call spread. So at the time when I had posted that, and I'll walk you through the trade here, what we're just going to do if you're on the Thinkorswim platform is that you're just going to sell, and you can have it's easily to do on the platform here, and we're going to do a iron condor. It's going to populate it for you, and you can see here that we have two sides of the trade here. I'm going to move this to the 185 and 180, and then I'm going to move the call side. Oh, actually, we're on the call side. So on the call side, we're going to suggest it to sell the 220 and buy the 230. And on the put side, sell the 185 and buy the 180. At the time when I posted this trade, it was at 295. We see a close of about 286 on here. But you can see here on the trade here in iron condor, we're selling the February 220 call. We're going to buy the February 230 call to create a call spread, but we're selling that call spread, so we're short that. So we're short the top end of that range, so the upside, And then taking on the other end of that, we're selling the Fab 185 put and buying the 180 put to create a put spread. And that is going to create a credit for us, and at the time it was 295. Closed at 286. So what we're getting in is our max gain is going to be this 286 of what we took on the credit. Where we start losing money is if prices start moving above and out of these ranges. So if prices gapped higher and started to get into that 222-ish range, we start feeling a little bit of pain. But with implied volatility coming out as well, and it's a trade of probability on an iron condor, and on these kind of trades, you're risking more than you are actually going to make reward. It's kind of opposite than what a lot of you hear on trading, that you want to risk less and have a bigger reward. So if you risk 10 cents, you want to make 30 cents. On these types of trades, it's more of a probability trade. So it's a probability of Apple. Is it going to move higher than 20 points? We've seen some gaps higher. The market that we've been in, we've seen the gap higher and it fades off. So a move like that's going to be pretty aggressive. And we go back to previous earnings here. You look at 190, we had a gap up to just about 200, so 10 points, and then you go back to last earnings. You look it over, and it doesn't, you don't really see that aggressive move. They really have to blow out earnings. You take in consideration of how far it's come, and put that into consideration as well. So 20 points is going to be a very aggressive. It's a trade of probabilities. With it setting up in the middle, it gives you cushion on both sides. So if we got a pullback and it really started to sell off into this 185, 180-ish area, we would start to feel a little bit of pain as well. But we are covered by buying that 180. So if it really gapped to this 140 area, the most we would lose is this difference between the spread, the money that we took in, minus the total spread of 5 points. So that would be the max loss on that one right here, but we protect. And that's why I suggest doing an iron condor. Some people will do the strangle, and by doing a strangle, you're selling the call and you're selling the puts, so you have risk to the upside, unlimited risk to the upside and to the downside. But that's the trade that we put on, and with the prices at 205, that looks to be a pretty decent trade with it just being flat going into and coming out of earnings. So if you have any questions, feel free to ask me or leave a comment, and I will get back to you. We will do it tomorrow, see what the market brings. We're getting into an area on the SPY. Oops. It's kind of shifting a little bit, the bias. We had 2 big days of pullback here, and we have a hold on support. We can see it move up into this area right here where my trend line is at, and retrace this a little bit, and then maybe make that next leg down, coming into this area right here. So that's something we're going to have to look out for and play. I've taken a few short positions, and I've taken off a lot of my long positions, and I'm just playing a few positions right now because as the market tries to dictate and figure out where it's going to go, there's a lot of charts that are still showing some bullishness in it, and there's also some charts that are showing some bearish setups as well. The only problem with those bearish setups is if you anticipate them, what we've seen in the last 9 months, they could really blow up in your face. So that's why I'm just keeping it very tight and very close.